Hi, and welcome to the Macro Show. We talk macro, and you wonder, are banks getting desperate for borrowers? We've got that. Remember that big liquidity flood that was going to come out of the Treasury's general account to all the stimulus? Well, it looks like that flood is turning into a trickle. We're going to preview, or at least try to make a big guess at this week's Friday's non-farm payroll report, look at some economic data, and maybe even get into some charts. So let's get right into our headline story, and that is, what's going on with the banks? Well, we've got the Senior Loan Officer Opinion Survey, or SLOOS. Not sleuths like gold mine sleuths, but SLOOS. And it's always based on the prior quarter, not on the coming quarter. And you can kind of look at it and say it gives you an idea of where senior loan officers are thinking that lending conditions are going. And it really gives you some eye-opening view from the inside. Because what's happened in lending the last quarter? Well, it's decelerated, and in some cases, we've got a contraction in commercial industrial lending and also a contraction in real estate lending. So, and that's not good. I mean, if you think, what is a bank out there to do? Is lend money to make money. Well, what happens when their loan book is shrinking? Well, it means the amount of money they're making on lending is going down. Let's take a look at that report and see what's going on. Now, this comes out quarterly. So this is the April report. It's at the Federal Reserve website. And let's go through these first few paragraphs. We'll take a look at the chart. It says, regarding loans to businesses, response in April survey indicated that on balance they eased. So why would they ease? Because they're looking for people to borrow money. So you ease standards to allow more people, in this case businesses, a chance to qualify. There's standards on commercial and industrial loans to firms of all sizes over the first quarter. Banks reported weaker demand. So despite easing financial conditions, so you think of this from a business perspective, right? You lower your prices or your ability to qualify in this case, and you have less demand? Not so good. Let's continue on. Weaker demand on net for commercial and industrial loans to large and middle market firms, and demand for commercial industrial loans from small firms remained basically unchanged. So wasn't much demand there at all. And standards on commercial real estate loans secured by non-farm residential properties remain basically unchanged, while banks tighten standards on construction and land development loans and ease standards on multifamily loans. So hey, if you were looking to borrow money to build an apartment complex, well, that got a little bit easier. Banks reported stronger demand for construction and land development and multifamily loans and reported weaker demand for non-farm residential loans. For loans to households, banks ease standards across most categories of residential real estate. Now, keep in mind, they ease these standards, and we're still getting a contraction in credit, saying that rates are too high. On net, and reported stronger demand for most types of residential real estate loans over the first quarter. Banks also ease standards across all three consumer loan categories: credit card loans, auto loans, and other consumer loans. Meanwhile, demand for credit card and other commercial consumer loans remained unchanged. Now, why might that be? Well, you give people money, maybe they don't need to borrow because they've got some money from the government. And demand for auto loans moderately strengthened. Now, we know that because auto sales are up. Now, this survey included two sets of special questions. One set inquiring about changes in banks' lending policies compared with pre-pandemic levels. So now the first two paragraphs were just the last quarter. Now we're going to go back and say, okay, how have things changed since to prior to the pandemic, since the end of 2019? By borrower risk rating, and one set about changes in commercial real estate lending policies over the last year. First, their answers were about changes in lending policies compared with pre-pandemic levels. Banks reported having tightened commercial, industrial, and consumer credit policies for most categories of borrowers on net. So even though the last quarter they eased a little bit, overall, lending standards are still tighter now than when they were before the pandemic. For commercial industrial loans, large banks tightened lending policies for most firms, except on loans to large investment grade firms, because, hey, they could just go out and issue all the debt they want, and the Fed was going to buy it. So, hey, they're not doing that anymore, but no problem. We give you all the money you want, for which they ease credit policies on net. Small banks tighten standards on all categories of commercial industrial borrowers, and especially on small and below investment grade firms. For consumer loans, banks tighten standards on all categories. So even though, again, in the last quarter, they eased a bit, overall, they're still tighter. Second, in their answers to special questions about commercial real estate lending policies, banks reported tightening most terms on non-farm residential loans and on construction and land development loans, and leaving most terms unchanged on multifamily loans. So even though the last quarter standards eased a little bit because banks wanted to lend more, they didn't get demand for it, and overall they still remain tighter. And so there's some charts that are included each quarter, and they're not always the same, but these are the ones they really like looking at. And we see net percent of domestic response tightening standards for commercial industrial loans, and you can see they eased a little bit. Now, if you don't realize this is a diffusion index, charted as a diffusion index, you think, wow, they went from tight to easy. No. This means over the last quarter they eased financial conditions. It does not mean they are now super easy. It is in relation to the prior measurement, in this case quarter. So it's read just like you would read those factory survey data, the ISM and the market reports like we did on Monday. So a slight easing of financial conditions. And if we look at net percent of domestic response reporting stronger demand, well, demand was still below zero. So that means there was less demand for commercial industrial loans. So despite easier standards, there was less demand. How about commercial real estate? And you can see net percent of domestic response tightening standards for commercial real estate. On net, they were still overall tight. Only on multifamily, they eased slightly. Overall, they tightened a little bit over the prior quarter. And if we look for demand for commercial real estate loans, well, they're going up. So people, hey, I'd like to get, borrow money or get money out of my property, or maybe even restructure my loan. And so demand for commercial real estate loans went up. But conditions tightened, standards tightened on those. How about this is neat, the residential mortgage loans. Now remember, this is one continuous graph with a break in there because of the way they adjusted to change the data they were tracking. So here you can see below zero, they definitely eased standards from the prior quarter. And how about demand? Well, and demand was up. We know that there is demand for real estate. It's pretty obviously in the real estate market. We can see that. How about consumer loans? And you can see an easing of standards on consumer loans, and willingness to make loans is up. So tightening standards eased a little bit. Willingness to make loans went up a little bit, and stronger demand for consumer loans was largely unchanged because consumers either are not wanting to take on more debt, or perhaps they don't need to. Again, government transfers alleviate some of the need for people to have to borrow money. Now let's talk about that liquidity surge that was supposed to happen. Now remember that the Treasury general account, or the savings account for the government, was going to get spent down to around its normal range of $300 to $400 billion. That's what we were under the expectations were. Well, now we've got an update from the Treasury on what they're actually going to do. So check this out, because this is interesting from the perspective that what we saw is people talk about how inflationary this was because all this money was going to come out. And it turned out, it hasn't been inflationary. But now it's kind of interesting to see what really happened, or what's really going to happen. So this is a sources and use reconciliation table. And you can get this from the Treasury's website. And it shows the financing need, how much they're going to borrow, other sources, the total, and then the change in cash balance. So if we go down here to April through June, they're anticipating borrowing $384 billion, and they're going to need it $384 billion. Most of that's going to be borrowed, $368 billion, and their revisions as of May 3rd. They're going to borrow $778 billion. The revision, it was actually revised higher, is their total need is $778 billion. I was looking at the wrong row, and their need for borrowing is $463 billion, and they were expecting the balance to drop down to $500 billion, and it turned out it's going to be actually at $800. Now let's go look at what that all translates to. Here is the Treasury General Account, and it's currently, as of April 28th, sitting at $967 billion. That number is obviously going to be down a little bit from now, but they are going to hold this $800 billion balance. So remember, this was all money was going to come out. We were under impression it was going to go down around probably likely closer to $400 billion, which is where it normally should be at. And now, for whatever reasons, the Treasury is going to sit on $800 billion and borrow the rest of it. So again, that inflationary surge of all this money that was going to come out, and this, this liquid, hot inflationary money, well, that story is about over, because this is only going to drain down about 167 billion, of which some of that has already come out. So far, what do we see? That banks are out there looking to get borrowers because credit's contracting. When credit contracts, what happens? Interest rates, boom, right? They got to go down to attract more borrowers. Now we had this inflation story from the Treasury, and what are we hearing from Treasury? Now we're gonna go the borrowing route and hang on to some of this cash balance perhaps for later. Why is that? Does the Treasury believe there's going to be a big infrastructure bill? Possibly. Do they believe there's going to be a problem at the next budget, and they're going to, Congress is going to fight over it, and they're going to need the cash to drain it down? Could be that. Don't know for sure what the reasoning is, but what we do know is that belief that all this money has come out and create all this inflation, so far hasn't. What we've seen inflation from is the base effects and rising crude oil prices mostly, and then of course due to shipping, the lag in shipping times and shipping costs rising, not from money coming out of the Treasury account. So let's take a look at the economic data, and there's some interesting stuff going on here. South Korea CPI year over year in April went from 1.5% to 2.3%, and they say, wow, that was big. But look at the month over month; it was only up 0.2%. So it's telling you this is all due to base effects. A 0.2% month over month increase is not going to drive the year over year from 1.5 to 2.3 on its own. So it tells you this is base effects, and this is going to get faded unless a month over month starts to jump a whole lot higher. Let's move over into Great Britain. We've got the manufacturing PMI. And what do we see here? It went from 58.9 to 60.9. So what is that telling us? It tells us the manufacturing sector in Great Britain expanded at a faster rate than the prior month, but that rate is not as great. So the rate of that increase is starting to slow down. And that's not a good sign, but that's consistent with what we're seeing, what we saw on Monday when we went through all the other manufacturing PMIs. How about exports and imports? Why are these interesting? Well, one, this actually tells you, is that increase in consumer prices going to be sort of validated? Yes. It also tells you is the economy expanding. So if exports are up and imports are up, they're up all around the world, well, that tells you the global economy is growing. In the U.S., it did. It went from 187 billion to 200 on the exports, and 258 to 274 billion on imports. And you can look at exports here, not near their pandemic levels that were around 210 billion. We're still ways to go on that. But imports way up, and we know they're way up because we're running the biggest trade deficit we ever have. And there you have it. The trade balance is at the largest level in history. How about Canada? Well, look at exports and imports. They went from 50.49 billion to 50.62. So exports increased, but not a ton. But look at imports. We're seeing, imports coming, in the U.S., Canada, 49 billion up to 51.76. So same story there. Imports are up, trade balance, and Canada pretty big as well. We're going to skip the Red Book data until we get back to some normalized month over month. Car sales, pretty flat in April from prior months, still nowhere near their pre-pandemic peak, and not even close. The market wants trucks. Consumers want trucks, businesses want trucks, everybody wants trucks, and you're seeing new highs in truck sales of 14.37 million units moved. Factory orders kind of disappointed. They were only up 1.1% month over month in March. Of course, we're going to expect to see that number coming down in the future. Let's move on to, let's see, we've got Australia Services PMI, 55.5 to 58.8. Tells you the services sector in Australia expanded at a faster rate. Now, as we talk about services, and I want to kind of, because we're going to get some more of these, and then we're going to get to the U.S. data here momentarily, is what I want you to understand is the manufacturing PMIs, I think it's better for you if I do this way, will peak, and about 2 months later you get the services sector peak. I want you to understand why that is. So, think of it, you're at a manufacturer, business is booming, and that means your employees are generally getting paid more, the demand for other things is higher, and so as the manufacturing sector is out spending money, that flows down to the services sector, and so it lags. There's a lag there, and it's around 2 months. So what we should normally be seeing is a peak in the manufacturing PMI, and then a couple months later, you want to see a peak in the services PMI. So what should our expectation be as we look over these services PMI data? Right, they should be going up, up, up. That's what we want to see, assuming the manufacturing PMIs are peaking as they are appearing. They are. So we should see services, and that's why the market doesn't make a huge issue out of the services PMI, because it knows. And not only does it know that it should be going up, the other problem is it's going up from a very, very depressed level because the services sector is the last to open. So let's see here, Spain, services PMI, 48. So it was a contraction. So under 50, remember, it's contraction in March, 54.6. So beat expectations, makes perfect sense. You would expect to see services sector up. How about in Italy? Services sector contracted in March and contracted again at 47.3. So that's not a positive for Italy at all. And let's go to France, services PMI. Now, we're not going to look at the composite. The composite is just a blend of the services and the manufacturing. It kind of tells you kind of what both are. Well, let's take a look at it. I mean, let's look at France. You see contraction in the services sector in March, virtually unchanged, 50.3, virtually unchanged in April. That's not good. And look at the broad composite between the services and the manufacturing, went from unchanged in March to just a very slight expansion in April of 51.6. How about Germany? Services PMI, very, very slight expansion in March at 51.5, unchanged, 49.9 in April. So the services sector is not growing here, and this is a problem because you would expect to see this. How about the broad Eurozone? Overall services sector was unchanged in March and virtually unchanged in April. So no growth out of the services sector. Now, is some of this due to the economies that are still being shut down, and when they reopen, this will come back? I would expect that. But so far, not a real positive sign from the services sector, which these numbers should be up. How about producer prices in the Eurozone? Went from 1.5 to 4.3 over year, and the month over month went from 0.5 to 1.1. So there is definitely some producer price inflation showing up in that month over month data to help push up that year over year rate of change. Let's take a look now at the U.S. data. We have mortgage applications down 0.9%. The overall trend in mortgage applications has been lower, and despite the bank's easing standards, and despite people wanting loans, the demand for applications is on net declining. How about the ADP non-farm payroll employment? Now, the ADP has been missing expectations, and we saw that data from the non-farm data from the Bureau of Labor Statistics last month, completely beat it, put around 1 million print. But then when you start digging the data, you find out that was really, really massaged higher. So ADP is coming in at 742,000 jobs for April, missed expectations at 800. And what are you already hearing in the chatter about the non-farm? Oh, it's going to be 1 million plus, maybe high as 2 million, maybe more 1.5 million. And that's going to drive interest rates, right? Of course, higher, but we know that the bond market's already telling us that whatever. So what is the reality that we should expect for Friday non-farm payroll report? I'm not going to be surprised if it's 1 million plus, somewhere between 1 million and 1.5 million. How much of that is going to be massaged and made up from the BLS? Well, we'll find out in the days following, but my guess is they're going to do everything they can to make that number look good. Now, how do we know we should be seeing numbers that big? Well, if we look at the pandemic unemployment claims, they've been falling. And so there is some expectation that those people that are not filing claims are back to work. But has it dropped substantially enough to say we're going to see a 2+ million? Not without the BLS really making things up. So I expect 1 to 1.5 million. But still, when you're looking at over 500,000 a week in unemployment claims, it tells you, again, not only is the BLS data lagging, which it is, it's not accurate. So it's the most made up number in the economics data that you can have. So I don't get too excited about it, but the market loves it. How about we have the market services PMI? Remember, market, M-A-R-K-I-T, a different company than the ISM. Services PMI expanded at a faster rate, 60.4 to 64.7 in April in the U.S., so showing that the U.S. Services sector is expanding. The overall composite blend between the manufacturing and the services sector went from 59.7 to 63.5. So again, it expanded at, it's telling you the two expanded at a faster rate in April. Now we get a little bit different picture from the ISM. In non-manufacturing PMI, or services PMI, went from 63.7 to 62.7. So, and the expectations were 64.3. So expectation we're saying, look, the services sector in the U.S. expanded at a faster rate. The actual said, no, it didn't. It expanded at a slower rate And that's telling you that perhaps maybe this is a peak, maybe it's just a 1 month issue here that will change. But this is not what you want to see. You want to see this still going higher. Now, what did go higher? Well, non-manufacturing prices went up from 74 to 76.8. And let's see what else. Employment went up a little bit from 57.2 to 58.8. But how about business activity? This is not good. It went from 69.4, estimates at 69.5, but to 62.7. So it says, look, services business activity slowed, and not a little bit. I mean, it's still a 62.7 number is great. I mean, don't get me wrong, but relative to 69, it says it's slowing. The rate of growth is slowing, not good. And what else went along with that? New orders, 67.2 to 63.2. So the growth of new orders also slowed. And we can go here and look at the ISM data, courtesy of the ISM website. And let's see if there's anything else on here. We see supplier deliveries are slowing the direction is slowing, and we see inventories pretty much unchanged. So the key here, maybe we're seeing a peak in prices paid, and backlog of orders is growing at a slightly faster rate. New export orders growing at a slightly faster rate, imports slightly faster rate, inventory sentiment. They're still saying the inventories are too low, but when you see business activity slowing like that, maybe the problem is prices are too high. Well, in a liquidity trap, that makes a lot of sense. How about this week's oil report? This was overall a great report. Crude oil inventories down almost 8 million barrels. Imports were also down. And you see gasoline inventories up a little bit, 737,000. And what about distillate? This is gasoline and your airline jet fuel. Distillate stocks down about 2.9 million barrels. Overall, great report that's going to put, and we saw crude oil, at least after report, go up, but this is going to put some strength under the crude oil market for sure. And with that, we will wrap up today's show. I appreciate all of you being fans as always. You know the drills, and thank you for supporting the show. It really means a ton to me. So I thank you. And with that, we will be back on Friday for the macro show. Take a look at the non-farm payroll data, and of course, see if those banks find some more borrowers, or else we're going to see more credit contraction. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video provides educational information only, is not intended to provide investment or other advice. Shows not to be construed as a recommendation or solicitation by a security financial instrument or to participate in particular trading strategies. Video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.